Ajay Srivastava, Managing Director at Dimensions Corporate Finance Services, joining us. Ajay, great having you. Let me first start off. You've been cautious with regard to Indian markets. What's kept you cautious? Is it the fact that valuations have run up, or you're not expecting earnings to run up as much as many are penciling in? What's keeping you cautious, at least where Indian equities is concerned?
I think good morning. I think it's not about just being about Indian equity, 2,74,000 crore being sold out by a bunch of all overseas global investors, universally across board, sends you a signal that something they're doing right and something we need to be cautious about. So when you people vote for 275 lakh crores getting out of the country, you need to heed that advice and you need to follow it. Number two, as you already seen, what's already played out in the market, what we've been saying, that the capital allocation needs to move away from equities, which all of us have done in the last 1 year or so. And you've seen the results of what's happened in the precious metal, etc. And third, the global markets. So I think it's not just you being negative on Indian equity, but also the fact that you need to diversify. India is just 4% or 3% of the global market. And commodities, of course, now you've seen after what happened yesterday in America and Venezuela put together, gold has become the major item that you must hold on a portfolio. So it's more about diversification. And when so much of sales happen by so many global companies and all of them are smart money allocating elsewhere, you need to follow their advice. And therefore, you need to, for our purposes, capital is limited. That's one. Number two is you need to look at risk-weighted returns. It's not necessary that you got 10% in India over the year. That's good enough. You took huge risk in India and equities, and therefore you get 10%, which is like an FD rate or just about there. That doesn't make sense to us. So I think it's capital allocation, sell-off, and Indian valuation all put together. We still have stocks in 70s and 80s Ps. Nowhere in the world do you have these stocks. Until they persist in the system, we will remain very cautious on Indian equities. And in fact, we are short on a couple of stocks at this point of time. And wherever we see P over 50 and growth is not commensurate, I think it's a fair game to believe that those stocks will correct down.
Ajay, therefore, are you preferring some of the contra plays, something like an IT? Do you expect that to bounce back? And are you finding favor in terms of valuations there as well, especially in the large cap end? Because you mentioned you're not comfortable with 70, 80 times earnings. Would IT therefore be your go-to?
The IT is not a go-to because, as you see in Indian market also, they have only performed with government policy changes. Nobody expected at the start of the year GST to be brought down for autos. Auto GST came down, autos outperformed everybody. You saw end of the year, there's a steel tariff come in place, and suddenly you see the steel companies doing it. At the end of the year, you saw cigarette tariff going up, you got an ITC going for a hammer down. So I think India is still subject to a lot of policy guidelines, that is one. Number two is Indian monopoly is doing well. There's no problem monopoly in India. So you don't need to change the thesis. Thesis has been auto, metals, one or two banking institutions, nothing much on banking side, but the focus, and of course telecom, the focus has to be where there is a moat for the company, number one. Number two is government policy expectation. If it changes dramatically, and you saw the fortunes of auto company just swinging around with the government policy change. So in India, you are really down to the fact expecting in budget, will there be some changes, GST changes put together, and same old theme continues. Capital market theme, the stock exchanges remains as lucrative as ever. So I don't think you need to change your theme from what you invested in 2025 to 26 to include IT, etc. in the bucket, because if you are, for instance, in a stock exchange or you are in telecom, you don't need to change that allocation to capital. They will do very well compared to all other sectors economy. So answer is no, IT is not on the horizon even at this stage. Those are a bunch of absolutely losers in this country, which is shame actually. They did a good job once upon a time. Again, with government benefit. Note till the point the tax benefit was given to IT, they did tremendously well. Moment tax benefit went away and the tax cut of 3 years back, the companies become flat again. So, we have a bunch of problem in India is everybody wants government to give them subsidy. Indian corporate is all about give me subsidy and I will perform. So stick to monopolies, stick to duopolies. I think we have enough companies, stick to metal. You can't create a mine overnight. Therefore, nothing goes wrong with them. And when market price corrects, you buy more. So I think theme does not change to my mind. Unfortunately, it's a very boring concept called don't change your horse at this stage. They're doing well, they're riding well, and they're healthy.
Okay, appreciate that analogy, Ajay. Hi, and wishing you and your team a very happy new year.
Thank you.
Thank you so much. You also spoke about how there is a need to be within spaces where we are seeing monopolies, duopolies. On the back of that, two very interesting themes, quick commerce and telecom. What are your views on some of those areas?
We are invested in telecom, so
Okay.
unfortunately there are not many candidates, so
Yeah.
it's you can't do very much to it till the second one lists. So there's only one company. The second one is, again I said, second one is subject to what government does. You saw the share price going yo-yo depending on how you interpret the government this thing. Now e-commerce is something that is an old Indian saying that you have it, you're going to you're going to hate yourself for buying it, and if you don't buy it, you're going to hate yourself for not buying it. So I put the e-commerce category, say, take 10% of your capital, invest in it, forget about it, steep correction, buy more. There are one or two good companies in e-commerce, but at these valuations, when you're entering, you're really entering into space with zero probability of error in the performance. So forget all sensibility. India can't live without e-commerce companies. Their valuations are nonsensical, but you have to be there. So take 10% of your capital, deploy it there. Don't remain zero out of there, hoping something will happen, but don't become 100% also, because these are valuations which may not justify in 3 to 5 years time frame. So my suggestion is 10 to 15% allocation. Don't think too much. Live with it. It's all against all norms of what you learned in business school. So suspend your knowledge base and just invest on gut.
Okay, invest on gut is the theme, it seems. Ajay, on that note, two big talking points looking at us in the next 1 month. One, you have the Q3 earnings season that's going to kick off in just a week from now. We've already had some very strong updates coming in from some of the banking names, some consumption names have done well. And the second one is, of course, the union budget, now less than a month away for us. But first, let's talk about earnings. Based on the updates that we've seen, Ajay, which pockets do you think will do well or will outperform the others when the Q3 numbers finally do come out?
I think they will, as we all know, autos are going to do well. There is no doubt about it. Telecom is going to do extremely well, no doubt about it. The stock exchanges are going to do extremely well, no doubt about it, including commodity exchanges. They will do extremely well, no doubt about it. I think the question remains, the broad to engineering companies, by and large, will do reasonably well, but they have an export problem, but still they're doing reasonably well. Auto ancillary companies, fantastic, no issues in that set of the companies. Pharma, big pharma, very subdued. CDMO selectively will do extremely well, I think, in the results coming out, because let's not forget the rupee depreciation to 91, and we forget that if you look at pound or euro, that's 15% depreciation. So while you alluded to IT can get some relief out of the European devaluation, which is upsides of 15%, not 5% of dollar. But the fact remains that pharma companies will do much better because they have a large export base into Europe and everywhere else expanding. So I think pharma, CDMO space will by and large do pretty well in this next horizon. What is not going to do well, I think, is going to be consumers. I think they're not going to do well at all. It's going to be garments, not going to do well at all. Anything related to retail market, stores, not going to do well at all, because bulk of the consumer buying has shifted to autos in the last 3 months. And autos have taken up huge money, put together whatever has been taken for loans, for holidays, etc. Not much left for discretionary. So I think discretionaries will have a very, very uncertain performance in this quarter as well, contrary to what most people believe.
Ajay, I'm hearing a positive tilt now with regard to at least auto. I'm hearing a positive tilt towards pharma as well. Are those your bets, or how are you placing your bets for 2026?
See, the bet is simple. First of all, is allocation. I think the allocation remains what it is: one third, one third, one third. One third global equities, one third precious metals and metals, and one third is going to be Indian equities. I think that's the allocation does not change very much. Autos, we have always maintained that India has the best ecosystem for autos in the world, including the ancillary setup. There is no one second to us. Maybe China a little bit, but by and large, India has done a tremendous job, and Indian companies are buying up companies in Europe, etc. So it's a global capability statement out of India, autos. And that's where the strength will come from India and will continue to strengthen. And we have seen the pro-policy stance. The GST has been brought down. Maybe some more tweaks may be done. But by and large, the factor is that autos will do well in this country because we have an infrastructure ecosystem to do well. So it's not about change of stance. It's the fact that what is good is good. Indian auto companies are good. They're strong. They're debt-free companies. Indian Auto ancillary is extremely good. We have a large ecosystem inside India. We don't need to import so many things, maybe aside from, for the EVs. But by and large, we are the global leaders in auto. So the auto segment really comes strength not because of the topical year, but the fact that underlying we are the strongest nation in auto in the world.
Okay. Ajay, I also wonder where you, therefore, within Indian equities, you spoke about one-third of our allocation being to in Indian equities. Where within Indian equities are you finding favor or value at this point?
See, as I said, stock exchanges do well. I think they do well. You may have corrections, you may have policy guidelines, but they continue to do well because it's very difficult. Even though there are one or two stock exchanges coming into play to come into either commodities or equity space over time, but it doesn't happen overnight. I think unlike America, where you have clearing allowed intra brokerages and hedge fund, India doesn't allow it. So it's kind of a monopoly for two or three exchanges in commodities and stock exchanges. You can't go wrong in that as we start to invest more money and and the trading volume goes up and the price goes up. Even if you trade the same, if you're trading on a commodity, the gold prices have doubled, the silver has doubled. So you can imagine the volumes passing through them. So I think stock exchanges remain a very small haven. The healthcare space, the hospital space is not done very well this year, to be honest. In fact, quite a bit of a negative, two negatives, three positives. But that space is brilliant because you can't create hospitals overnight at the end of the day. It'll take you time to get the return, but hospitals remain the best healthcare play in this country. We spoke about telecom. We spoke about two or three financial institutions which are on the gold side. The gold loan companies, they've done extremely well. I think they will do still well. The key is actually not sectors. I'll tell you the key is pedigree. 2026, you need to go for pedigree. That's all that is required. Whether it's a finance company, engineering company, whichever sector you choose, just choose the one which has performed over 5-7 years, has a strong pedigree of professional conduct. And when you mentioned e-commerce, why I said 5 to 10%? Because I'm very, very worried about the thinking of India's e-commerce entrepreneurs. Very short term, cutthroat. You've seen what happens. You say something, deliver something. Therefore, my relief is go to pedigree companies in gold loan, go to pedigree companies in auto, go pedigree companies in engineering, and I think you'll do fine at the end of the day. Defense remains a good theme, but overvalued in most pockets at this point of time. And I do not know how Indian companies will deliver. We have a holdings, but it's one of the things which can outperform everything in this year, unlike last year, or it may just give you as bad as performance. So outlier is defense companies to my mind.
Okay. And Ajay, the point you were making about being with pedigree companies and of course defense. Now, these are some pockets that have done well, no doubt, but the valuations continue to be elevated. Is valuation a concern at this moment, or do you believe the fundamentals are strong enough for valuations to be slightly ignored?
See, the issue is not valuation, issue is scarcity. You don't have any companies. You have 4 or 5 companies. All are mostly large ones are PSU. 1 or 2 are private sector. Large ones are PSU. So it's not about even valuations. I think valuation-wise, they're fine in terms of the intrinsic value. May not be versus PE or EPS, but they're really good quality order books sitting on the books. Question is execution. Can they be privatized? Can they get enough professional conduct to do what they're supposed to do, deliver? You saw the comment of the Indian Air Force chief on HAL. Come on, guys, deliver the planes. We got the orders. There's no shortage of orders. So unlike rest of India companies who are struggling to create demand for themselves, this is one segment which sits on orders, cannot execute. And if something is done to make them execute, I think the valuation will be of no consequence. It's not a question of valuation. It's a question of performance and delivery. If they can do it, these are far more valuable companies for a state like India compared to what they are. So no concern on valuation, concern on execution. Orders are abundant. This is the only segment which is sitting on orders. Unlike any other company in India struggling to get orders. If they execute, I think they're undervalued. If they don't execute, okay, we got a bad investment, a part of our portfolio.
Ajay, you've spoken about, within the BFSI pack, you've spoken about stock exchanges being one method of playing the financialization of savings game. The second one you've spoken about is gold financiers, and high pedigree gold financiers is what you spoke about. What else within the lending universe that you're liking? Because these are such small niches, you have very limited options to invest in, at least where gold financiers and where stock exchanges are concerned. Where else within the financials do you like, or find
You
value?
you're obviously a very rich man because we can't even find enough capital to invest in them, my friend. There are enough options in them. So obviously you are looking at a different set of capital than what I am or we are at this point of time. But having said that, I think there are enough companies. There are enough impact. There's some PE transaction which took place last year, which gave an opportunity at this point of time. So there's no shortage of companies. I think it's a question of how much capital you allocate to each segment. And again, back to the point, what policy guidelines come in? Tomorrow, the government wants to curb gold loan financing. They can just bring in an LTV guideline saying 60% or 50% and so on, and you suddenly have a problem. So there's no shortage of companies in the segment. There's no micro and the stock exchanges. You can get they are large exchanges. You can invest a lot of capital with them and pretty safe capital. So and last point is you got to do concentrate bets in this market. There's no point of spreading yourself over 40, 50, 100 companies because the market does not perform this way. And we have seen 2025, we've seen USA, we've seen Europe. The same logic applies. The top 10, 20% of investment choices will determine what money you make. What's the point of allocating less to a star when you have spread it over? So my suggestion is pick up those 20, not more than 15, 20 stocks. If you're a decent portfolio, if you're larger, it's of course different animal, and focus on them, keep investing them. Same as metal. You don't have many choices in metal companies, but then you have to go invest in those companies. So it's good actually sometimes that we don't have so many choices because the companies select themselves through the portfolio. You don't need a fancy research analyst. You just look at the company pedigree, performance, and you say, we are safe here.
Okay, Ajay, appreciate that outlook coming in, and
Thank
thank
you.
you so much for your time today.
Thank you very much.